Uh, some of the major technical analysis tools are the trending indicators and the oscillators. The trending indicators includes the moving averages and the Bollinger Bands, and the oscillators includes MACD, RSI, ATR, and several other oscillators. Indicators are used in two main ways: to confirm the price movement and the quality of chart patterns, and form buy and sell signals. Make sure you use them fairly consistently and don't overcomplicate things. We would see all this in detail in our next slides. There are three kind of moving averages: simple moving average, exponential moving average, the weighted moving average. Why do we use these moving averages? That is one of the very important points. Moving averages are being used for finding a cross point between the moving average and the price chart. Finding the points following the lows and the highs of moving average. Finding the points of extreme divergence between moving average and the price chart. Tracing the signal direction of moving averages movement. Now we'll practically see this in our next slide, that how do we use moving averages. See, there is a simple chart of Euro USD on which we have a moving average. The moving average can be placed for different days, like a 15-day moving average, a 30-day moving average, a 90-day moving average. So see, whenever you see that the price cuts the moving average from above, okay, now this is a bearish candle. It cuts the moving average from above, and the close of this candle is below the moving average. Whenever you see this kind of a sign, this is called a sell signal. Then the price moves on and on and on. Again you see there's a bullish candle. Okay, the close of this bullish candle is like on the moving average, or you can see it as above moving average. So whenever you see this kind of a signal, again it's a buy call. Again you see this candle, this is a bearish candle, it cuts the moving average from above. This candle again is a bullish candle, and it cuts the moving average from below. So whenever you see a bullish candle cutting the moving average from below, and the closing of that candle has to be above the moving average, then it's a buy call. When you see a candle cutting the moving average from above and the closing of the candle is below the moving average, then it is a sell call. So this is how a simple moving average works. Like suppose tomorrow if you're seeing a chart of any Euro USD or a GBP USD, you can just put a 30-day moving average or a 15-day moving average, and then you see, like, start observing the candlestick chart and the moving averages together, and just try to find out whether does it works this way or not. Just check whether a bearish candle, when it cuts the moving average from above and it closes below the moving average, does the trend goes down for some time, and vice versa for a bullish candle. So this is how a simple moving average works. Now you also use the combination of moving average, like you use a 15-day and a 30-day moving average. On daily time frames you use 120 and 150. I mean either of these. Using a Fibonacci sequence is also one of the very important and useful tool to do a technical analysis. We'll see the Fibonacci retracements in the later slides. See, now this is called as exponential moving averages. When we use a combination of two moving average, one is a 15-day moving average and one is a 30-day moving average. When you use a combination of two moving averages, it's called as exponential moving average. It is called EMA. So the red moving average is the 15-day moving average, and the green is the 13-day moving average. So whenever you see the red moving average cuts the green moving average, and on the upper side, it's a buy trend. Same way, when this red line cuts the green line from above and it goes below that, it's a sell trend. Again, this red line cuts the green line from below and it goes up, so it's a buy trend. So it's very simple. You can just put two kind of moving average. One is 15-day moving average and one is the 30-day moving average. Whenever you see a whenever you see a 15-day moving average cutting the 30-day moving average from below and it is going up, it is a buy call, and the vice versa for the sell call. I repeat once again, these are the two moving averages. The green line is a 30-day moving average, the red line is the 15-day moving average. When the 15-day moving average cuts the 30-day moving average from below and it goes up, it forms a buy trend. Same way, when the same moving average, the 15-day moving average, cuts the 30-day moving average from above and it goes down, it's a bearish call, it's a sell trend. So that's how these exponential moving averages work. The first which we studied was a simple moving average, and this one which we are seeing is called as the exponential moving average, wherein we use a combination of two moving averages. Okay, now one of the very interesting things what we have is called Bollinger Bands. Okay, the lines plotted in and around the price structure to form an envelope. You see these envelopes, envelope here, envelope here, and envelope here. It is the action of prices near the edges of the envelope that we are particularly interested in. We are not interested in this kind of a movement. We are interested in this kind of a movement. So whenever you put Bollinger Bands, you got to find out these kind of movements. Okay, these two lines, the topmost line and the bottommost line, are called as the support lines and the resistance lines. So whenever you have, whenever the price chart is moving towards the resistance line, okay, you know that from there it has to come down. See, here it is cutting the resistance lines. The candlesticks is like cutting the resistance lines from below. So here it is facing a resistance. So it should click that, yeah, so now this is a sell call from here. You can take a sell call anywhere here because everywhere it is hitting the resistance lines. So whenever you see the price chart, the price hitting the upper band of the Bollinger, you know that now this is going to be a sell trend. Same way, from here it comes down. Now here it is hitting the lower band of the Bollinger. So it's finding the support here. So once the price finds support somewhere, it goes up from there. Same way it finds resistance somewhere. So here if you see, it is moving between the Bollinger band. If the price is moving between the Bollinger band, we don't have to do anything. Only when if it hits the upper band or if it hits the lower band, then we come into action. Then we see, yeah, it's hitting the lower band. Here, see, it's continuously hitting the lower band. So then from here it goes up. Here it is continuously. This is like not very clearly crossing the upper band, but if you see, it is like continuously trying to break it. So it's finding a strong resistance here. So again it comes down from here. Again it sees a good support here, so it goes up from here. So Bollinger Bands, it basically helps you to find out the support and the resistance and when should you take a buy or a sell call. This is called as the moving averages convergence and divergence, which is in short called as MACD. So here, this is the typical movement of MACD, wherein you see it touches the high, it goes down. Again, it touches the same point, again it goes down. So here it keeps on making new low, and then here it goes below the line. So the moment you see this kind of a movement, it should click that yeah, now it is going into a selling zone. Okay, so from the selling zone starts from here, it is on till these lines. Okay, till the line doesn't makes a new low. It is this line, the point is hitting this line, this line's point is hitting this line. See here, the line starts getting smaller. Okay, so now you know that now again there's a trend change. Okay, so till the time you don't find this point, okay, you don't take a sell call. This movement is very much fine. This is a bullish movement, but then when it reaches this point and it forms this line, there is one more line here which is not seen because of the dot. So when it forms this kind of line which is below that, it goes into a sell territory. Again, it keeps on making new lows here and finally goes above the line. So the moment you find this point, it again goes on the buy zone. So this is how the basic MACD works. When you I'll also practically show you how do you put the MACD on the charts, and you know how do you exactly read it. See, this is a typical movement of MACD. If you see, it makes a new high here, it goes down. Now this high is below this high, so the strength is getting weaker, and finally it forms a bar here, and then gradually it goes down. So the moment you find this kind of a movement, it should click that yeah, now it is going into a sell zone. Same way, when you take a bullish call with MACD, what indicators helps you to do that? Here it makes a high, okay, it goes up, again it comes down. Okay, so now this high is lower than this high. Okay, so see, if you see this arrow, it is sloping upwards. Okay, here if you see this is sloping downwards. So these kind of movements, they help you to find out the selling call or a buying call. But these will just give you the trend. Okay, I mean the trend can be found out from moving averages, Bollinger Bands, and the oscillators and trend indicators. Trend indicators, they help you to find out the trend, and these oscillators, they help you to see how strong the trend is. So oscillators, they support the trend indicators. Now, one of the very important oscillator is also known as relative strength index, in short, which is known as RSI. Now, how to read RSI? RSI would have 3-4 figures. One is the 30 level, one is the 70 level, one is between them the 50 level. Whenever the line goes below the 30 level, it is considered as an oversold territory. Okay, so whenever you see, I'll show you practically, just a minute. See, you see this RSI line, okay, and these two lines, okay. The below line is known as the 30 mark, the above line is known as the 70 mark. So till the time it is moving between these two lines, it's fine. The moment it goes above this line, this entire territory, okay, this entire territory above the green line is known as the overbought territory, and this entire territory below the 30 mark is known as the oversold territory. So the moment it goes above 70, it should be alert that yeah, now it has got into an overbought territory, now it will be a sell trend soon. Same way, whenever it goes below 30, it's an oversold territory, so it should be alert that now yeah, fine, it has got into the overbought territory, sorry, oversold territory. So very soon it will be the buying trend. So this is like a very simple working of relative strength index, which is known as RSI. If you compare the price chart with RSI, it moves very much similar. See, here it goes into the overbought zone, here it is making a top. So now if you sell it here, see, it straight goes down, then again it goes up, but then here you don't take any call, okay, because it has not yet gone into the oversold territory. Till the time it doesn't goes into the oversold territory, you don't take a buy call. So same way the entire chart moves. The moment it goes in any of these territories, you make your call. Now this is one of the oscillators which is known as stochastic, which works on the volumes. It is very much similar to the RSI. RSI has the level of 30 and 70. Here it has the level of 20 and 80. The moment it reaches the level of 20 on the lower side, you take a buy call. The moment it breaches the level of 80 on the upper side, you take a sell call. If you see it doesn't remains above 80 for a longer time, as well as it doesn't remain for a longer time below 20. So you make your calls in this territory. You don't do anything when the price is moving between 80 and 20. So this is what is called as stochastic. A drop in a volume indicates a decrease in interest towards the current price dynamics. A rise in volume indicates an increase of market participants' interest in the current price movement. Volume peaks signals a reversal. Like see here the volume peaks, so it signals a reversal. Again here the volume peaks, it signals a reversal. It's like you know, the selling starts from here, there's heavy selling here, then you see buying starts from here. So these price movements you'll see very heavy volume because people start buying at this level. So you'll see a very heavy volume at these levels. Now Forex is known as the OTC market. OTC market is known as the over-the-counter market, wherein you don't have any regularized exchange. Like we have the NYSE, which is the New York Stock Exchange, wherein there is an regularized platform to trade in stocks. But when you talk about the currency markets includes currencies of various countries. So, and the participants are also from the various countries. So the settlement cannot happen on one exchange. It cannot happen in one country. That is why it is called as the over-the-counter market. Now it says tick volume analysis assists you in sizing up the market on an intraday base. It means that volume, how much is the volume today? It helps you to find out how strong was the trend on the buying or the selling side. Information pertaining to open interest and volume is not available because transactions are carried out over the counter and not through exchanges. As I told you, over the counter market is a market wherein you don't have a regularized exchange. Wherein you don't have a regularized exchange, you won't have all these datas because there is no such only one regulatory body governing it. Now currency futures market. Open interest and volume data on currency futures allow you to gauge the market sentiment in the currency futures market, which also influences and is influenced by the spot market. Whenever you talk about a futures market, the underlying asset for a future market is always the spot market. Like you talk about the stock futures, if you talk about a stock of Walmart and the future of Walmart, then if you talk about Walmart future, the underlying asset for it will be the stock of Walmart company. So any company which has its, wherein you can trade in the company's future, the underlying asset would always be its spot, which is the stock. So same way, wherein you talk about the currency future market, the underlying asset would always be the spot currency market, because only with the spot currency market the future currency is affected, the future market is affected. What is open interest now? I have been talking about open interest from past 1 or 2 minutes. Now what is open interest? Open interest is the total number of contracts entered into but not yet offset by a transaction or a delivery. In other words, these contracts are still outstanding or open. Like if I bought one lot of future, I have bought it. Okay, I haven't yet sold it. Whenever you do a vice versa position, it's called as a closed contract. Whenever you enter into a position and you haven't yet done the vice versa position of it, it is called as an open position. Either you buy or you sell. Both the positions are the open positions. When you buy, to close the position, you sell it. When you sell, to close the position, you buy it. If you don't do the opposite action of it, it means the position is still open. And the number of open positions helps you understanding that how many people are interested in that market, in that future, on the particular price. So the more number of open interest, the more is the volume, the more is the participation, and more is the liquidity, and more movement can be expected in that currency or that stock future or a gold future. It can be anything. Okay, we spoke about the Fibonacci retracements in the starting of the presentation. Now, how does Fibonacci works? If you see these numbers, okay, it's 0, 1. 1 plus 1 is 1. 1 plus 2 is 3. 2 plus 3 is 5. 5 plus 3 is 8. 8 plus 5 is 13. 13 plus 8 is 21. So this was invented by someone whose surname was Fibonacci. The last name was Fibonacci, and on his name this entire technical analysis pattern was introduced by him. That is why it is known as the Fibonacci retracements. Now we have something called as a golden ratio, which is 0.618. Then it goes ahead. We'll see in our next slides that how do we exactly use the Fibonacci retracements. Why is it used? Is to determine the correction levels, determine the target levels for a price increase or a decrease. See, whenever you want to draw a Fibonacci retracements, you take the bottom of a candle, the bottommost of the candle and the topmost of a candle, whichever is the highest peak and whichever is the lowest peak. You draw a straight line from one point to another point and you will have these kind of this retracements. Okay. Now whenever you see the price movement, okay, it finds the first resistance at this point, 618, which is a very important level. The moment it crosses 618, these are the small resistances which it has at 50, at 32, at 23. But the main resistance it finds it as is at 00 level. That is why the golden ratio is known as 0.618. This is the main resistance. This is the main resistance. If it breaks this, it goes straight till here. Again, when it comes down from here, it directly comes till this 61.8 level. So it moves, mostly it moves in and around of 0.618 level. Like we saw here, 0.618, the golden ratio. Here is it, 0.618. 0.618. Mostly the price moves in and around between this level. See, when it comes down, it hits this level and again goes back. So once it breaches this 61.8 level, then in future 61.8 level becomes a very strong support for the currency movement, and the 00 level, it becomes a very strong resistance. So when you see the price movement moving up from here, just wait for it to break the 61.8 level. Once it breaks this level, it goes straight up till 00 level. It hits the 00 level, again comes down till 61.8, finds a support here and again moves up. So the levels which you are supposed to keep a watch on is when it breaks this level, when it hits the 00 level, again when it hits the 61.8 level. But then you buy or sell only when it breaches this level and when it is somewhere at this level, because you should be sure that it has comfortably breached the 61.8 level, which is this. When it goes up, it touches this level, it comes down, you sell only at these levels, because you know that it has come down significantly and it has broken this level once, so it will come down. Again, when it hits the 61.8 level, you don't buy here, you buy somewhere here. I'm so sorry. When you see a little bullish pattern forming, then you do a buy. So this is how the Fibonacci retracement works. So we saw, like, we'll just go back to our all the slides, and we'll just do a small revision of all the slides. Yeah. Which are the trending indicators? The moving averages, Bollinger Bands, and the oscillators are the MACD, RSI. Now how do you differentiate between the trend indicators and oscillators? Let me tell you one thing. The trending indicators are always plotted on the chart, and the oscillators are always plotted below the chart. I'll show you how has it been done. This is the MetaTrader. I'll just increase the size of the trader. Okay, I'll open a new chart. Okay, the new chart window we open. Okay, I just move, we don't need these current and the 3-year separators, we'll just remove them. Okay, fine. So now this is a typical chart of a Euro USD. Let's make it as candlesticks. Now we'll just zoom in a little. Okay, so if we can find these candlesticks a little proper shape. Okay, whenever we put a moving average, okay, I just go to what? Charts, bar sticks, candlesticks. Okay, let's go to the navigator. Okay, now we have various options here. Okay, see, if I say moving average, I just pull it here, I say okay, fine, you see a moving average on the chart. Okay, now if I put Bollinger Bands, okay, bands. Just a minute. Okay, you see Bollinger Bands on the chart. Okay, so these are the trending indicators which have been put on the chart. Okay, so you see it breaches the upper level of upper band of Bollinger, it comes down. It breaches the lower band of Bollinger, it goes up. Again breaches, again it goes up. Again breaches the upper level, it goes down. So this is how the Bollinger Band works. Now let me delete the Bollinger Band and we just see the moving average. Okay, see this bullish candle breaking it's cutting the moving average from below a bullish candle. The closing of the candle is above the moving average, it goes up. Here you see a bearish candle. I'll just zoom in a little bit. See, here you see a bullish trend here, a bearish trend here. This is a bearish candle. The close is below the moving average, it straight goes down. Here the bullish trend starts, but then you don't buy it here. You buy it only when it closes, cuts the moving average from below and the closing is above. Then again it will form a bullish trend, and you see next day the market opens right on the top around 150 points up. So there's how the moving average works. So these two, moving average and the Bollinger Bands, are the trending indicators which have been plotted on the chart. Now we'll see the oscillators. We spoke about the MACD. Let me plot MACD for you. A normal simple MACD. Bring it here. I say okay. You see MACD here. Now let me zoom out a little. Yeah. See, as we spoke about, here it makes new high, new high, new high. This is the high, first high. Then it makes a new high here, again a new high here. So this is the start of the bearish trend. It goes, it makes a new high. So you take a sell position and you wait. You wait till here. Then you see a low. So here you get alerted. Yeah, now the trend is going to change. So you wait. Only when it crosses and starts going on the upper side, you take a buy call here. You see it going up, making new high, new high. It makes a new high here. Then you see it gradually coming down. So you sell off your position here, then you wait, again it makes new low. See, you see this bar, the size of bar keeps on decreasing. Okay, here you see the size of bar keeps on increasing. So whenever it again goes here, you actually wait, you don't take a position. Okay, you take a position only when you see a new high. There is the high, again this is the new high. So when you see, if I draw a trend line here, okay, the trend line will be like this. So when you draw a trend line, you should see, yeah, here it should click that, yeah, now this is the bearish trend happening. You see this white dot here. Here you should take a sell call. Same way, when you go for a bullish trend, you see for new highs, and there's how you can take a buy or a sell call based on MACD. We spoke about RSI. We'll also take a look on RSI. Again, RSI is a form of oscillator which is plotted below the chart. If I just pull RSI here, I say okay, you see a line of RSI here. Now I delete the MACD. Okay, see 100 level and the 0 level. In just a minute. So now you have a 20 level here and an 80 level here. Same, this is like a stochastic RSI, and one was the simple RSI which we spoke about. The stochastic RSI has the 20 and the 80 level. Same way the normal RSI would have a 70 and a 30 level. So the moment you see this breaching the 80 level, you start being alert. You just wait for it to come down. The moment it goes below 80, you take a sell call. You sell it somewhere over here in the sell zone, somewhere near to the 20 mark. Again it goes down, you know that now it is below 20, so it's in the oversold zone. Whenever you find it in the oversold zone, you take a buy call. You take a buy call, you sell it somewhere over here. It's because you don't know what level can it go up till. So you buy in an oversold zone and you sell it somewhere in the buy zone. Okay, if you see this middle line, this is a 50 line. Okay, the above the 50 line, this is a good buy area. I mean, the buying is strong here. This is the good sell area. The selling is strong here. So when you buy from an oversold zone, you sell it into the good buying area. When you buy from an bought zone, you sell it into a good sell area. So these areas are for you to close your positions, and the extreme areas are to take your positions. This is how the RSI and the stochastic RSI works. What else did we speak about? The moving averages, which we already saw it on the real chart as well. We can also see the Fibonacci. Okay, let's take a new chart window. Okay, we should grid off. Period separators we don't need. Fine. Okay, now how do I draw a Fibonacci? As I told you, you have to take the lowest point of the lowest candle and the highest point of the highest candle. I'll just zoom in a little. We'll make it as candlesticks. Okay, fine. Now where do you find a lowest and the highest candle? This is the lowest point of a lowest candle. Here is the highest point of the highest candle. You can also take it as this point. Depends, like, which levels you wish to see. Okay, you see it moving up from here. It breaks this level of 61.8, like we said, the golden ratio of 0.618. It breaks this level and straight goes up till the 00 levels. So now you expect this to come down to 61.8 level. This is what the Fibonacci says, that if it breaches the 61.8 level, it straight goes to the 00 level, which is here. Again from 00 level it comes down to 61.8, find the support here at 61.8 and again goes up. So this is how the basic Fibonacci retracement works as.